The recent movement that we've seen in the market really has to call into question a strategy that has worked so well for investors for the better part of 10 years. Buy the dip has really been a wonderful strategy for investors for the most part, pretty much since the debacle of 2007, 2008 resolved itself. Sort of the ultimate dip there was, I guess, when the markets when the S&P was in the 600 range, 667 range or whatever it was. That was the ultimate buy the dip. But on the other hand, you'd have gotten a little run over had you been buying the dip up to that point. But since then, you really can basically take a look at the markets, draw a line upwards, and realize that as we've been in this long uptrend, it's really been a great trading strategy to try to buy dips and hold on and use them as buying opportunities. If you look at a chart, let's say, of the last 2 years, pretty much from mid-2016 till just recently, the S&P 500 has followed its 200-day moving average higher very consistently. When you have bought a dip, when the market sort of had been riding above its 200-day moving average, and a great strategy had been every time the market touched its 200-day moving average, you probably wanted to be looking to buy stocks, and it has worked out for you, depending on your time frame. However, there's always a however, it hasn't worked so well during this recent market environment. We bounced off the 200-day moving average, but now it seems to actually be providing a little bit of resistance rather than the support that it had. And you have to wonder, it's very dangerous to say, well, it's different this time. So you have to think before I say, well, it's different this time, why it's different this time. For starters, we really have not seen the support from the moving averages that we've seen prior. We also, in an interesting way, are starting to see the 200-day moving average roll over. When you think about the fact that there's really about 250 trading days in a year, so you're talking about a moving average that's basically taking up 80% of the time in a year. So it takes a long time to move one of those averages, and you're starting to see that turn lower, and not in a meaningful way right now, but even the fact that it's cresting and potentially rolling over is something pretty significant that you should be thinking about. So why is it different this time? The Fed. Over the past decade, we've had a super accommodative Fed, and basically any time there was selling in the marketplace, there's been this wall of money behind it. Some have called it the Fed put. I think that's more specifically when there's a major drop. But basically, the Fed had been there pumping in liquidity, and so for the most part, money is what makes the markets move. And you had this backdrop from the Fed adding money consistently. The Fed had started to get a bit less accommodative, basically about a year ago. But at that same point, you had tax reform. I'm going to call it the corporate tax reform because that's more what's relevant here. And so, around the same time that there was this wave of money that was cresting, that you really weren't seeing the Fed adding the type of money to the system, companies were, because the corporate tax changes gave serious incentives for companies to be buying back their shares. So instead of necessarily there being this Fed source of money, you had companies providing money to the marketplace and reducing the supply of shares. All that has been very beneficial. So what's different now? Well, we're more or less at the end of this first year of tax reform, and I think people have started to build in how much stock will be bought back, and companies will continue to do so. But there's not this frenzy anymore. It's more of a drumbeat in the background rather than this frenzied buying that we're seeing. Also, the Fed has dropped the term accommodative. The Fed is actively starting to tighten monetary conditions. Rule number one of trading was always don't fight the Fed. You got away with it for most of the past year because there were other factors helping you out, a different set of exogenous factors. So I have to start to wonder now, does the mentality change from buy the dip to sell the rip? That was always the other side of the buy the dip equation, but we'd kind of forgotten about it. So do we flip now to selling rallies? And I think it's a little early to say that the psychology has truly changed, but I would really like to see where this market goes before I become too sanguine again. I think you've got to see the market consolidate at these levels and make another test of the 200-day moving average, this time on the upside, and would have to be a successful test before I would say, okay, this was a one-time event. If not, I think we may be in for some choppy action, possibly with a lower bias, because we're starting to see some economic worries creep in, the fear of peak earnings hitting the markets, and the backdrop of a Fed and global central banks that are not particularly friendly right now. So it's a longer term, more global call. It's not really meant to influence trading on a short-term basis, but you really have to start thinking in terms of how has the psychological backdrop, how has the monetary backdrop, how has the economic backdrop changed? And if you think that it's all hunky-dory and it's exactly as it was throughout all these prior market pullbacks, then that should color you toward buying the dip. If you think that there is a market change in all those factors, then you might want to be conditioned to do the opposite, which is sell rallies and maintain a more lightly balanced bias toward the market, toward the stock markets.